There's one tool that professional traders are always watching, almost obsessively. It's not just another squiggly line on a chart, it's more like the market's secret dashboard. We're talking about the India VIX, and it gives you this powerful, predictive look into what might be just around the corner. So let's dive in.
But really, think about it for a second. What if just one single number could help you predict market fear, understand those wild swings in option prices, and even give you a hint about what the big institutions are up to? Well, that number actually exists, and by the end of this, you'll know exactly how to read it.
So here's the game plan for today. First, we're going to pull back the curtain on this secret dashboard. Then, we'll learn how to decode its messages. After that, we'll get practical with a playbook for your option strategy, see how the pros combine it with other tools, and finally, wrap it all up with a simple daily checklist you can start using right away.
All right, first things first, let's get right to the heart of it. What is the India VIX and why in the world does everyone call it the fear gauge? Sounds pretty dramatic, right?
Okay, so in simple terms, the India VIX is just a volatility index. It's a number that basically gives us a 30-day forecast of how much the Nifty 50 is expected to bounce around. But here's the crucial part. This isn't some analyst's guess. It's calculated directly from the prices people are paying for Nifty options right now. It's literally the market's own prediction of its future choppiness.
At its core, the VIX is telling you one of two things. When the VIX is high, it means fear is in the air. Traders are expecting big, wild moves. On the flip side, a low VIX means things are calm, stable. But, and this is a huge but, that calm can also mean complacency. And that's a word you have to remember, because complacency is where hidden traps are often laid.
But it's not just some vague feeling, right? The actual numbers matter. The specific levels of the VIX are sending you direct messages, and learning to read them, well, that's the next step.
So when the VIX drops below 12, man, that's a big deal. It's a major signal. The market is quiet, maybe a little too quiet. This is the zone of extreme complacency. And while it might feel safe, pro traders know this is exactly when the market is most vulnerable to a sudden shock or a really sharp reversal. Now, on the other hand, if you see the VIX spike up above 25, that's signaling extreme fear. Panic is in the air. But here's the crazy part, the paradox of it all. This peak fear often marks the point of maximum pessimism. It can actually signal a potential market bottom. You know the saying, buy when there's blood in the streets? A high VIX is what tells you the streets are flooded.
The whole key is just matching your strategy to the environment. It's pretty logical when you think about it. When the VIX is low, fear's low, which means option premiums are cheap. That's a fantastic time to be an option buyer. But when the VIX is high, those premiums are jacked up, which is a perfect setup for option sellers who want to collect that extra income. If you expect a huge move but you're not sure which way, something like a straddle can make you money from the volatility explosion itself. And if you think things are going to be boring and range-bound, a strategy like an iron condor can profit while that VIX slowly comes back down.
Okay, so the theory is great and all, but how do we actually make this stuff actionable? How do we use it to trade? This next section is the playbook. This is where we connect these VIX readings directly to what you should be doing with your option strategy.
Now, this right here is a classic professional setup, especially around big events like the budget or an RBI meeting. You'll see it every time. In the days leading up to it, uncertainty builds, and the VIX just climbs and climbs. On the day of the event, it usually peaks, but the second the news is out and the uncertainty is gone, the VIX just collapses. This is called the volatility crush, and it's exactly why so many pros love to sell options right before an event, planning to profit from that predictable drop.
Now, the VIX is incredibly powerful for sure, but the real pros, they rarely use it in a vacuum. They combine it with other indicators to get confirmation. It's about building a much stronger case before they put their money on the line.
So what's in this pro-traders combo? Usually, three key things. First, they look at Max Pain, which helps them see where the big option writers want the market to end up. Second, the put-call ratio, or PCR, which is a great gauge of fear versus greed in the market. And finally, they look at the VIX's own trend, just to confirm if a volatility spike is for real or if it's just a fake-out. So let's see how this works in practice. Imagine the put-call ratio drops below 0.7. That's a sign of extreme greed. Now, what if the VIX starts to rise at the exact same time? That's a huge bearish red flag. On the flip side, let's say the PCR is above 1.3, showing tons of fear. But then, you see the VIX start to fall. That's a powerful bullish signal that the panic might finally be burning out.
All right, we have covered a ton of ground, so let's bring it all together with a simple daily checklist you can use to make the VIX a core part of your trading routine starting like tomorrow.
It's a really simple 5-step process. 1. When the market opens, just check the VIX level. 2. Compare it to that normal 12 to 20 range to see if we're in a high or low volatility zone. 3. See if that reading lines up with the Nifty's trend and the open interest data. 4. Based on all that, pick the right options strategy from our playbook. And 5, and this one is absolutely critical, adjust your stop losses. When the VIX is high, you need wider stops just to survive the choppy waters.
Okay, here's a pro tip for you. Watch for divergence. We know that normally when the Nifty falls, the VIX rises. But what if the Nifty is rising and you see the VIX starting to rise with it? That is a massive warning sign. It's the market telling you that it doesn't really trust the rally, and a reversal could be coming soon.
Another smart move is to look outside our own market. Volatility is contagious, right? Keeping an eye on the US VIX gives you really important clues about global risk appetite, and that sentiment often spills right over into our markets.
And finally, here's a more advanced tip. Focus less on the actual number of the VIX and more on its rate of change. Think about it. A VIX that slowly drifts from 12 to 16 over a week is interesting, but a VIX that explodes from 12 to 16 in a single morning, that's telling you something completely different. The speed of fear is often what really matters. At the end of the day, I think the best way to think about the VIX is as a weather forecast for the market. It can't tell you the exact price the Nifty is going to hit, any more than a weather report can count the number of raindrops. But it will absolutely tell you whether you should prepare for a calm, sunny day or a violent storm. It tells you whether or not you need to carry an umbrella.
The VIX gives you the power to be prepared, not surprised. So the only question left is, now that you have the forecast, how are you going to prepare for tomorrow's market weather?